If you look historically, the companies that tend to perform over the long term, and by that we mean the next 5 years or longer, are those that can actually grow and deliver high and sustainably high returns on invested capital. And to be clear, most companies do not go down that route. On average, when companies get high returns, they tend to be competed away. But for those, and probably less than 20% can do that, they're actually great investments. But even better, what we really excites us around about future quality would be a company that go from, instead of just being a great company, staying great, an average company turning itself into a great company. Not only do you get the growth that goes with that, you typically get a higher valuation as well. Much harder to find, but again, the very things that we seek. And the only things that we have in our portfolios are companies we believe are on that future quality path to either sustain high returns or improve to reach and sustain high returns on capital. We've already mentioned the importance of being on that path of attaining and sustaining high returns on capital. But then the other element of what we look for in our portfolios is a company also has the 4 quality pillars we think are critical. So for example, is it a great franchise that can keep delivering much better returns than other competing companies? Does it have a management team that we trust to reinvest, to grow the business and sustain high returns at the same time? Does it have a balance sheet and cash flow that even when times are tough and debt capital proves to be fickle in both price or availability, they can keep reinvesting to grow the business when others don't? And then finally, the valuation, the price that you pay for that future growth and cash flow, is already all captured in the share price, or is it attractive and providing further upside? So when we invest, we only invest in those companies that are on the right path and meet each and every one of those 4 key pillars. But the emergence of AI has been a remarkable change within markets, and it's got a couple of dynamics that go with it. One is creating a major economic opportunity, and very quickly and for the first time, for those companies that are leading that major adoption wave, indeed arms race, literally or otherwise, to spend and develop AI. NVIDIA being a particularly good example of that, which we own in our portfolios. But equally, the emergence of AI is also, to some degree, enhanced the depth and the width of the moat around some other technology franchises. And that's created a dynamic in markets globally last year where many larger companies were being reappraised as effectively being the more defensive havens of choice because AI is making their business more defendable, they've got strong balance sheets, and they're delivering growth in a world where it's harder to find growth. But that dynamic also created its own kind of rotational force where people are buying companies just because they're big and large. That rotational buying can actually push some prices up of share prices over the short term. But that's not what you invest for. What you invest for is only in those companies that are share prices are reflecting stronger fundamentals of better growth, better cash flow, and higher profitability. AI is leading for some companies to deliver on that front, but others maybe not. And that's why I think it's fascinating when you look at the market today. Those leaders, AI related or otherwise, such as NVIDIA or Meta, are performing very well because their profitability is growing remarkably. But others that benefited just because they were big, the reality of slower growing businesses with downgrades and disappointments, they're no longer leading factor falling in share prices. So we live in a market which is actually reflecting quite correctly the better fundamentals. I think the lessons we take from 23, where there's obviously been a change of leadership, is that our job is to find those companies around the world, wherever they are, that most meet the philosophy we think is really important, that future quality path. And I think some of the leaders we didn't own initially in the early part of last year have turned out to be the absolute winners in that race of future quality. Those companies that are improving very quickly or sustaining much higher returns than we expected are actually where you want to be as an investor. And particularly in the current environment where central banks are trying to make growth more difficult still. So finding unique and uncorrelated areas of growth, of which AI is obviously one element behind that, that's exactly what we want to seek. So I think it's what the lesson learned is, the world changes, and where the best and greatest companies are, and you're paying the right price for that opportunity, you should absolutely embrace that. So I think us taking a view to change our portfolios, even initially we missed out the very first move of a bigger, longer term adoption curve. We actually believe it was still right to buy the likes of Nvidia and Meta. It felt tough at the time, but if you look what we've delivered in the last few months, clearly there's clear signs actually it's never too late when it's a multi-year growth story of adoption. I think if the question is what's happening with the macro and what does that mean for investing is a really tough question to answer at this point in time. We continue to live through that great monetary experiment, going from QE to QT or whatever Q is going to be next. And the market's still struggling to work out actually to what degree can central banks easily solve the inflation they help create to begin with. But what it looks like to us, without making any great predictions on that front, is definitely the cost of money looks like it'll stay higher for longer. Growth is generally going to be more difficult, so the average company does not have a nice tide to lift all boats. So therefore you want to find those unique businesses or areas of the market where there is actually better growth or less correlated growth due to a variety of circumstances. We've talked about AI already, but other areas are going to be some of the healthcare providers in terms of solving the problems of today's society where healthcare is too expensive, but they can make healthcare more efficient. From a delivery perspective, we think have got a big growth opportunity ahead, but still not fully recognized today. Growth and global travel will be another thing we believe is a multi-year story in terms of the cohort from India, China and elsewhere joining that global tourist population as GDP per capita continue to rise and they're allowed to travel, are types of structural things we think are going to be ongoing. Which brings us back to what do we really look for with our future quality approach, is to just be invested in 40 stocks on those different paths, the ones where they're generally growing, sustaining high returns on capital, and becoming better. And we find those in a variety of different areas of the market, and that's what we've been doing globally. And that's what we set out to do for our investors, to compound other capital in high quality businesses, delivering very high returns back to you as a shareholder and growing at the same time. Last reflections I would share, we've been through a very interesting and challenging period last year where we've had a massive shift in both monetary policy in terms of rates actually going up a lot for the first time, or indeed the emergence of AI and the ramifications that has for some of the winners or losers within the market. The one thing we've learned from that is actually when things are more difficult or changing, what you always fall back on is, do you have the right team working together, focused with absolute clarity of what you're looking for as an investor and what your philosophy is? That's exactly what we've done. We've gone always back to the foundations of our future quality approach, the clear and differentiated process we've got. We've made some changes in the portfolio. Thank goodness we did, because the world has evolved to mean there's some more different companies leading this time. Our job is to find them, the best of them, and build them into a portfolio. And thankfully, the returns we've seen in recent months are very much reflecting we seem to be on the right side of that.